Here is your MTPredictor weekly market update for September 23rd. Again, I'll start with the S&P. That's kind of our proxy for all what's going on here. Here's the weekly chart. You can see the pattern here. I'll clear it off and you can see it visually, but if I use the tools in the software here using the Elliott wave tools, it picks it out for you nice and cleanly. And you can see we've gone beyond the minimum wave 5 as our QE announcement. We got another leg up. Haven't gotten quite into the typical wave 5 as we had options expiration week. We've gotten that out of the way now. And we've got a little bit more to go before we get in that typical wave 5. But what's different, as we talked about before this time, is most of the corrections over the last couple of years have happened in minimum wave 5 is where we've tended to correct, right? We've gone beyond that now, so this is something new. For instance, if we go back to the last correction in wave 5 here, right, this was back in May and of 2011. This correction came typically they come back to the wave 4 decision point there. But again, this is where we corrected. If we go back prior to that, this was the correction back in April of 2010. Okay, again, in the minimum wave 5 resistance area, correction typically back to the wave 4 DP. Okay, so you can see that pattern has been established. In fact, even if we go back to the March lows of 2009 here, it was a 5-wave pattern down right into minimum wave 5 resistance or support. Here was your typical. Never made it to typical wave 5, only to the minimum, and that's been the case each time. Minimum wave 5 before the correction. Again, minimum, here's your minimum wave 5 before the correction, and then of course where we've come now. Right, this is a little different because we've gone beyond minimum wave 5. So that's, I'm just pointing that out because this is unprecedented. We've never had, QE3 in the history of our markets this way. So in a sense, all bets are off. We can't look to the past in a lot of this stuff to see how is the market going to behave because we've added something to the mix here. It's kind of like putting a natural bodybuilder on steroids. Well, maybe the progress we can expect would be different than if he was just continue to be a natural bodybuilder. Now that he's on steroids, he can go to new levels that he may not have been able to achieve naturally. Well, that's kind of a similar case here, if you will. All those dollars that the Fed is going to be pumping in, it's not just our Fed, it's the central banks around the world now. You've got Japan printing, you've got of course Europe announcing their bond buying, and so this is going on worldwide, and we've never had this before. So again, obviously patterns are patterns, and they will continue to unfold as such, and they have for hundreds and hundreds of years. But in this area, we notice there's a change. Something's a little different this time. The correction didn't happen in minimum wave 5 as it has the last few years, and so we take note of that and maybe adjust our thinking a little bit. Anyway, if we want to look at the Dow as well here, you can see again gone beyond minimum wave 5. Not quite reaching the typical wave 5, which in the December contract is going to run around 13,720 area. So not quite there yet, but you see how the patterns are similar. We got the markets behaving, essentially the same pattern in the Dow as we have in the S&P. Right, so these markets are moving together fairly well. The NQ, if you want to take a look at the NQ for December, this one's interesting because you do have we've gone beyond minimum wave 5, again that same pattern here, but you do have a decision point sell signal there. Now this is against the bigger trend, which is up, Obviously you can see the trend is up, but we're looking at potential market top. Again, well, if I put the analysis on this, you'll see the S&P would have, or I'm sorry, the NASDAQ here would have to get down to 2837 in order to trigger that particular trade. If it never hits that, then obviously there's no executable trade. Well, you can see the target on this. This is again the weekly chart. This is bigger picture stuff. Down to 2366. That's the decision point off the wave 4 swing low here. All right, I expect that we're probably gonna go higher, and they'll achieve these typical wave 5 targets in these markets. But like I said, we could certainly correct. You can see you got divergence here. So we've got a higher high in price, a lower high in the oscillator, and the software is picking up that divergence in a potential market top area, and that's why it's given that signal there. But again, we could certainly begin to correct, or it's that time of year. We're in those positions where the market does typically correct. But like I said, we've gone beyond where we've typically corrected the last few years. So be cautious about being too aggressive in these areas. As far as the short side, to the long side, obviously the risk is higher and higher as we go here. So keep that in mind as well. Better to, if you're going to be a buyer, is wait for the correction and then look to be a buyer, instead of trying to buy up here and then get a correction and then get taken out of a potentially good trade after the correction. All right, let's look around at some of the other markets. I want to look at the silver here. Again, this is the daily chart of silver, and we had drawn our lines here. We got the breakout. Some of us here were buyers or adding 2 positions based on the break here in silver, and you can see it's reached the decision point resistance off of this last swing right here. It's held up pretty well. Now gold, if we look at gold, we'll see that gold has not quite achieved the next level resistance area. So silver may be hanging in there waiting for gold to make another pop higher. But we are in resistance here in silver. If we want another support area, let's just look at downwards. This looks like wave 3 here, so we're going to project wave 4 down. And that area is right around 30 area. So if we do get a correction here, this would be another potential area if you wanted to look to be a buyer. And then for the next move higher, which would be obviously potential wave 5, or this next area just above 39, next resistance area. So let's take a look at gold, because a lot of this will depend on what gold does, as silver tends to follow it. All right, so you can see how similar these markets look. Here was your break out of this kind of triangle, if you will, this pennant. Okay, got the break there and a move higher. Here's the resistance area that we're looking at for gold. All right, so we've got some room to move higher here. You see it's consolidating, and we'll see if it breaks back to the upside, similar to what we had in here. Again, this is the daily chart, so looking at 1820 area. 1820, 1830 area there begins that resistance. And again, if we go down to the weekly chart, here's that same break on the weekly chart. Again, it's in those areas where the professionals like to accumulate, below the 50 period, which is the red line here, but above the 200 period, the blue line. And again, we've seen historically when we get below that 50 period, above the 200 period over the last, when gold is in a bull market, that's where the professionals tend to come in. Obviously, that's where they came in again. You had your George Soroses and those people of the world buying gold in here. We saw the SEC filing where Soros sold a lot of the bank stocks that he had in their fund, and was purchasing gold. So he obviously changed his mind, because before, maybe a year ago, was saying gold was in a bubble. Obviously he's changed his mind about that. So we'll see how these continue to progress. You see where the next resistance area. So gold's got a little more room to move to the upside before it comes into its next major resistance. Silver's already there, so we'll see if gold forces that up, silver to break that resistance to the next level, or if we can begin a correction based on where silver is. We'll see. Let's take a look at oil. All right, so we talked about oil. This is the weekly chart being in some resistance here, which was our wave B, and we projected down wave C. And so we've made some progress, towards the C leg down here, which is again around 77 or so, the top of the next support area. If we go to the daily chart, remember we had a sell signal. I gave you the numbers for that. Obviously that did hit the entry point there at 97.98 and hit the target there at 93.14 for plus 2R. So decent little trade there. If we get looks like we just about got a close Friday below that decision point area. If they take the low out here, then maybe we see that wave C target on the weekly chart, or at least this decision point support area from the daily chart, which is around 85, almost 90. I'm sorry, 85, around 85.90, 85.9, 85.90, not 85 or 90, 85.90. All right, and then bring in the euro. Let's take a look at the euro. Again, this is the daily chart, and you can see we had, again, doesn't matter, we looked at the S&P and the nice 5-wave patterns down. Well, here's the euro on the daily chart, right into typical wave 5 target here. Again, the tendency is we expect we get a correction back to the wave 4 DP. If this area gives way as resistance, then we should see this area. All right, so it looks like this swing high may be in. If they take this swing high out, we should see this next area here. We did get a close above that decision point, and that high got taken out, so maybe already telling us they're going to seek this area. If we look at the weekly chart, on the weekly chart, again, also had a 5-wave pattern down with the reversal in the typical wave 5. Here's your decision point off of the wave 4, and so this is where we would expect at a minimum this market to correct to, and that would correspond with that next level resistance on the in that ballpark area of the daily chart. All right, so that means that our dollar here in the US now did come into some support. You can see here a little high volume spike telling us that we may have had some buyers stepping in here, professional buying stepping in this support area, and so we may get a little bounce here. And you did see the euro rolling over a little bit after it exceeded that DP resistance, and rolling over a bit because the dollar has come into some support here. And this low here, you can see the target. We came just shy of that. All right, but it's still out there, and so we'll just have to see how things play out. But obviously, it's going to be interesting because Japan has announced their quantitative easing, and they're trying to devalue the yen because it's hurting their their import-export, and so that's when we devalue our currency in the euro, and it's kind of a race to debase, as they say, because it's affecting their import-export. So, in other words, the governments tend to want a weaker currency just to, it makes their goods cheaper overseas, and it's good for jobs, and if they have jobs, that's good for votes. But when you've got all the different countries wanting a weaker currency for this reason, you can see kind of the bigger picture of what's going on. But so we'll see how this plays out. This dollar continues to find support here, and we get a bit of a rally off of this. You'll see the euro is going to roll over a bit, and we'll kind of see how this plays out. We could just kind of go sideways as things kind of level off, but that quantitative easing, that QE3, that should hit the market probably another 3 weeks to a month or so. We'll start to see, I think, that hitting the markets, and we'll kind of get an idea of what that's going to look like. Question is, do we correct before then? Before that money gets put to work? That would be an interesting thing to see the markets correct, and then all that money come in. So watch this next month or so, next 3 weeks to a month, around that time frame, to see what we get here. We're in that area we could certainly correct when we talk about the stock market. Another thing I was just kind of looking, put on the radar here, this is the Australian US dollar pair, and this is the monthly chart, so a bigger picture here. But Australia's been going through they've kind of been insulated. They're a resource-rich country, been kind of insulated from all the economic turmoil that's going on in Europe, and here, of course, China's been a big part of that, because China's been buying their resources, getting the resources from Australia in large part, and so it's been a boon to the Australian economy, and they've had a big real estate a bubble basically now. That may all be coming to an end. So watch this market. If this channel continues to narrow here, and then we get a break, but as the Chinese economy now is shrinking, even though it's still around 77% GDP, or which we would love to have here, but they're going from double-digit GDP growth, down to single-digit GDP growth, which is a big contraction, and Australia may begin to feel that, and so that real estate bubble there may be coming to an end. At least we're seeing the high-end properties there are sitting on the market now. Your more affordable, kind of bread and butter properties, your 3-bedroom, 2-bath type, are still selling. Still hasn't been really impacted yet, but that top end is starting to crack. So keep an eye on that. Just kind of put that on the radar in the back of your watch list, if you will. All right, so we'll leave it there. I used up a good chunk of time there, but covered a lot of ground, I think, and we'll be back at it and check out what's going on. Again, keep your eye on the next month or so. Should be interesting.